You don't want to miss this episode. It's the July update at Control and Compound. What's going on in the market? What's going on with interest rates, real estate, business? Let's dig into it. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell. Joining me as always, Christina Wyatt. Christina, how you doing today?
Hey, Darren. I'm doing great. We're into the summer weather, and I couldn't be happier.
Oh, I love summer. I love summer so much. You live in Canada. You gotta appreciate every sunny day in the summer because we don't get a lot of them. So it's been lovely so far. So let's dig right into it. Let's start with the Bank of Canada, and then we'll get into some inflation, and then we get some really kind of exciting stuff to tell you later on. So let's go.
Yeah, for sure. So our last Bank of Canada announcement came out on June 4th. Where they announced that they were going to hold the overnight rate steady at 2.75%. So there was no change, same as what happened in April. Again, no change. I know people were looking for a bit of a cut there, but did not happen. The reason for that is, well, what they're saying behind the reasoning for that is that core inflation still remained high. So if you look at the CPI inflation, we'll talk about that in a minute, but it's at 1.7%. So it seems low. But if we look at core inflation, it's actually sitting around 3%. So don't really have it. It's not lower there. We also still have, the labor market's a little bit dicey with the tariffs, and we're seeing hits there, but it's not actually, it's kind of resilient at this point. They're saying that we haven't seen enough of a hit at this point to be able to reduce those interest rates. So our next announcement is going to be coming out on July 30th. And at that point in time, they're also going to be putting out the monetary policy report. So we'll have some more details. We'll have a little bit more information on what's going on out there, and they'll announce something. Now, looking at it, people are saying that probably not going to be a change in July, so don't get too excited if you're looking for a rate cut. But long-term, maybe 25 to 50 basis points before the end of the year. But we're really going to have, what they're saying is once we see that labor market being affected more, unemployment rates going up, then we could see it go, but that just hasn't happened yet. So good on one side, I suppose, but no interest rates cuts on the other.
I don't want to wish a bunch of people to lose their jobs so we can get a cut at interest rate, but I'd love to see a cut in interest rates for so many of the listeners out there.
Yeah. So looking at inflation, like I said, it remained unchanged at the CPI, the headline CPI was at 1.7%. Same when we had the report back in April. Core inflation went down. It was 3.1. Now it's at 3%. So it's still in around that 3% mark. If we look at some notable trends, food prices are up 3.3% year over year. Shelters up 3% year over year. Gas prices are down 15.5% year over year. So that's kind of what's keeping things balanced, I would say, I guess. So again, like key takeaways, the core inflation is still high, but that CPI headline is at 1.7%. So we'll see what Bank of Canada does next month.
And what about our Canadian dollar? Are we back to even par yet with the U.S.? How's that going?
Well, it's better than it was at the beginning of the year, I would say. Like it was pretty low there for a minute. If we look back as January, we're as low as 68 cents. We're at 72 cents right now. So we're at 72 cents for the Canadian dollar. Not bad. We did take a dip about a week ago from taping this. We took a dip, but we came back up. So we're sitting around 72. So it was the weakest level in over 2 decades back in January when we had that 68 cents. So we're doing okay. Some of the factors are obviously the uncertainty around the interest rates, like the Feds are doing things differently over there. So, we're looking at that. We've got the volatile oil prices. We've seen that for the last couple months. And then we've also got the lingering trade tensions. So I know there's lots of other stuff that's going on, but that is still happening in the background. So, and then the last one was just weaker housing, employment numbers, things like that. So, well, it's not at its lowest. It is, if you go over, we were over in Nashville not that long ago. You can feel it. You can feel that hit. It is definitely not on par by any means.
Yeah. Every time you go, oh, this looks pretty cheap. And then it's like, oh, plus add 40%.
Yeah.
Cool. Okay. So if we jump to the stock markets here, the S&P 500 in the U.S. is up the last month, 3.7%. So a nice rebound there. So the U.S. markets are up 4.5% year to date. And the Canadian market was up 2.4% in the month and 7% year to date. So we're still seeing on a year-to-date basis anyway, the Canadian market outperforming the U.S., which is a little surprising. It's great, but a little surprising. Then if we jump to Bitcoin, well, another exciting month on Bitcoin, all kinds of things happening. Bitcoin's around 107,000, down slightly on the month, up 15% year to date, and still up 73% on a 1 year basis. So 73% over the last 12 months is pretty great. Now, you mentioned we were in Nashville. So whenever I fly anywhere, I always say, okay, what can I learn on this flight? So I downloaded a bunch of podcasts, and I listened to the Jordan Peterson podcast where I had Michael Saylor on. And for anyone that's a Bitcoin fan, Michael Saylor fan, or wants to be, or wants to learn more about it, I encourage you. Like, these are just two brilliant minds talking for an hour and a half about Bitcoin and Michael Saylor's story. Michael Saylor, of course, is the president and CEO of Strategy, the Bitcoin reserve company that's buying billions of dollars of Bitcoin every month. So there were two great stories from this podcast I wanted to share. The first is the currency story. So almost all currencies eventually fail. So government prints too much money, the currency devalues, and it fails. So we look at Argentina, Russia, Brazil, Germany, even ancient Rome. All those currencies eventually failed. On average, there's a currency collapse every 30 to 40 years. If you look at the Argentino peso, so picture you had your money in Argentina, you were living in Argentina, and you had the Argentinian peso. Well, over a 20-year period, you would have went from 1 peso equals $1. So they were on par. Within a 20-year period, it took 1,000 pesos to buy $1. So your purchasing power was basically gone to zero over a 20-year period. So picture that person that had their life savings in pesos, and this collapsed over a 20-year period. There's no bouncing back from that. It was absolute devastation. And even the best currency, so in the last 100 years, without question, the U.S. is the world reserve currency. The U.S. has won, right? They've won, all the major wars they've been into with Canada's assistance, but they've won. It's the dollar. The U.S. dollar is what everything is traded at in the world. But if we look at the U.S. dollar, if you bought a $100,000 Miami Beach house in 1930, that house today would be worth $100 million. So think of that. Your purchasing power on that $100,000 over a 100-year period decreased 99.9%. Like, that's significant. And that was the winning currency. So if you could go back in time and pick, I have a time machine, I'm going to pick the best currency to be in, well, you still lost 99% of your value. So that works out to about a 7% inflation per year, not the government inflation people talk about, but the actual printing of the money and the devaluation of your purchasing power. So not a great store of value currency. So what about gold? Well, how is gold as a store of value? Everyone considers gold a store of value, and it's a pretty good store of value, but it has a half-life of about 36 years, which means you lose 77% of your purchasing power in roughly 100 years. So let me explain that half-life thing. So the gold supply grows by about 2% a year. They're still mining it. They're still finding new gold. So every year we have about 2% more gold, okay? So imagine if you owned 100% of all the gold that's above ground right now. You owned 100% of it. You had all the store of value in the world, all the gold. Well, at 2% a year, if you just had what's in there or you above the ground today, in 36 years, the gold supply would double. Think of the rule of 72. 72 divided by the interest rate is how many years it takes to double. So 72 divided by 2 is 36 years. So in 36 years, the gold supply would double, and you would only have half of all the gold in the world. Another 36 years, you'd have 25% of all the gold. Another 36 years, so we're out to approximately 100 years, you would have had, you'll have 12.5% of all the gold. So over a 100-year period, you lost 77.5% of your purchasing power. So even gold, your purchasing power is going to be devalued. Now, I'm an Austrian economics guy. For those of you that follow Austrian economics, I'm a big fan. Infinite banking is really built on the Austrian economics model. And Austrian economics always tells us, well, gold is sound money. And it's true, gold is sound money, but it's not perfect money. So it's a good store of value, a great store of value, but it's not perfect. Now, what if we could have a perfect store of value? So let's think of something with, say, a fixed supply where there's not going to be able to make any more. I don't know, like a fixed supply, say, of 21 million. And then we make it easily transportable. We can do transactions electronically. It's easily divisible into little small pieces. It's not controlled by any government or individual that can start manipulating or printing money. It's safe. It's secure. Well, we call that Bitcoin. And that's really the idea of Bitcoin being a better version of gold, because once they hit 21 million, there's not going to be an extra 2% growth a year on that. So the premise is you're not going to lose the purchasing power of your dollar. So anyway, encourage you to check that out, the Michael Saylor on the Jordan Peterson podcast. Next time you're flying somewhere or you're driving in the car, you're at the gym. Very cool podcast.
Disclaimer, not encouraging Bitcoin.
We are not Bitcoin
cool
experts.
Story.
We're
I
not
like
telling you to buy
yeah.
Bitcoin. We just find it fun to talk about. Not Bitcoin experts. Do your own due diligence.
Sharing stories.
Sharing stories. Just sharing. Just sharing.
Just
All right, Christina, what about real estate? How's that looking across the country? Same old, same old? Some places great, some places not so great?
Not huge changes. Although looking at May's data, they are saying we're cautiously improving. So the national home prices actually held steady over that month at 691,000 after we had several months of decline. So the fact that we're holding steady, that's a positive. Sales rebounded 11% from April. So down year over year, yes, but we're seeing some traction there and sales going up, which is great. So listings rose, pushing supply closer to, long-term normals. Now, regionally, like you mentioned, Vancouver, Toronto, they're continuing to pull back. If we look at the average home price in Vancouver, it's down 5.8%. Toronto's down 4% year over year. But if we look at some of those other markets, those mid-tier is kind of what they say, especially Ottawa, Calgary, Halifax, Montreal, they're looking at gains between 4 to 8%. Wow. So it is, people are starting to look at those markets for sure outside. Now, we do still have, again, those trade tensions they're still talking about, and that is impacting the real estate market as well. So experts are projecting that we will see a 2% nationally drop across Canada in 2025, so about a 2% decrease. But again, if we look into specific regions, you're not going to see that everywhere. There are different places that are doing quite well. Which brings me to some news that I found when I was doing a little bit of research on what was going on in the real estate investment market. Just this past month, there was a new fund that was launched that investors can invest in, obviously, that is targeting, it's called Western Canadian Real Estate Growth Fund, and it's just targeting the Western area for multifamily units, light industrial properties in cities like Calgary and Edmonton. So I'm just bringing it up to show that you're seeing more and more people, funds, not just individuals, but investment firms looking at those outside areas because they're seeing those increases and they're seeing long-term stability there too, right? So it's, we're seeing some confidence in those secondary markets. Another cool article that I was looking at was an anonymous NHL player. So they're not saying who it is yet, but an anonymous NHL player actually teamed up with a development company in the GTA and is investing in affordable rentals, which is really cool. Like I like to see, community-minded investing and, so the higher net worth individuals coming in and investing in those developments too. It's kind of putting that investing momentum back on the radar. You hear those kinds of things. It gets people looking in and checking out new developments. So that was a kind of cool one that I found as well.
Excellent. Well, we could use more new developments and more good
affordable
economic
rentals,
real estate investing news for
Yeah.
sure. Economic news. So we've got a new prime minister and a new government, and there's been no drastic changes yet.
But they're on vacation.
But well, yeah, they got to take the summer off, right? I mean, they don't want to hit the ground running, so they're going to sit for 20 days or something and then take some time off. But I thought it was interesting. The parliamentary budget officer, Yves Giroux. So he's an independent guy that works for the federal government, parliamentary budget officer, and he is hammering Carney to do at least an economic update now, or update his fiscal numbers, or do a budget. So it was interesting. That's the independent watchdog. So he came out and said the federal government's finances are at risk of eroding the government's credibility with investors. So he's saying we've got a credibility issue now because we're not disclosing these billions of dollars that campaign promises. We just committed another $9 billion to defense spending. So that's going to be a big deal. He also talked about the slow economic growth causing economists to forecast a larger budget deficit than last year. Again, we're still forecasting. The last update we have is Trudeau's government's fiscal update, which tended not to be too reliable. And the Prime Minister is not going to put out the budget till October, citing the trade war and shortened sitting of Parliament because of an election. So normally budget documents are always done in the spring. So there's a bunch of question marks on the government's fiscal plan. A budget would be very helpful in clearing up the uncertainty and providing more detail, this independent watchdog says. So some of the government spending plans I mentioned on defense, and then we've got some of these campaign promises. We've got the Canadian Imperial Bank of Commerce. Their economists are predicting that the deficit may rise as high as 3% of GDP. So what's that mean? That means it would be in the $90 billion range. The government's saying $34 billion. CIBC saying it could be as high as 90. Bank of Montreal thinks it's going to top $70 billion. So again, the deficit is how much more we spend just this current year than we bring in. And to put that in perspective, I looked up Trudeau's deficits for his time in there. So ending in 2016, the deficit was $1 billion. That was the year he kind of took over from Harper when the budget was bounced. The next year it went to 19 billion, then to 19 billion, 14 billion, 39 billion. Then in 2021, it went to 327 billion. That was COVID. Then it dropped to 90 billion, down to 35 and 61 billion. So new government, same government, new prime minister. And according to the bank economists, our budget deficit is going to continue to increase, which drives up our debt, which drives up our borrowing costs, which drives up our expenses to cover those borrowing costs. We've got the credibility issue with people because we haven't released these numbers. So not great on that side. I'd love to see just, whatever the numbers are, I think he should be releasing them, saying these are the updated projections based upon all this new stuff I'm going to do, or the new stuff I've committed to, like the defense spending. So again, if it's necessary, the defense spending, great, but let's get some updated numbers. And the parliamentary budget officer is championing that.
Yeah, some of those numbers don't even seem real. Like they're that large that you're like, that can't be right. I looked at it, I was like, is that the right number? Okay, I guess it is.
That's like, again, that's not paying off any of her debt.
No.
That's every year just spending 70, 80, 90 billion more than we're bringing in.
And there was a time when it was balanced. There was a time, right?
Yeah,
it doesn't seem
ago.
achievable looking at these numbers.
Yeah, and I mean, even going back further, I mean, Kretsch and the Paul Martin government, they did a great job. They came in and they actually cut government spending by 10% and ended up bouncing the budget. So again, governments on the conservative and the liberal side have done the tough things that needed to be done to get the books in order. Time will tell if Mark Carney will.
Yep. All right, heading into some industry news. So what's going on in the industry, the insurance industry?
Well, we get some dividends announced. So typically whole life, participating whole life, once a year they announce the dividends. So Canada Life increased their dividend up to 5.75. Manulife held theirs at 6.35. Equitable at 6.4. And we're still waiting on Sun Life, but no real surprises there. Just, same old. Whole life is just boring but effective. Amazing vehicle. Tax-free, all the things we talk about. Great news. The dividends are either slightly going up or being held. A couple other industry news things I thought interesting. We geek out on this stuff because we're meeting with insurance company head offices all the time, learning what's coming down the pipeline, learning how to serve our clients better. AI is huge across the board, and every company is big in AI. And I'm not saying one's better than the other, but Manulife did win the first ever Number one life insurance for AI at this Evident Maturity for Evident, this insurance industry event. So Manulife was awarded that. But I know I can speak to the other carriers we deal with heavily investing into AI. So I think it's going to mean lower premiums long-term, better whole life dividends as we can use AI to decrease or insurance companies use AI to decrease the costs.
Yep.
You know, we talked before in previous podcasts, sometimes over 40% of cases are underwritten now by AI. So that's taking a human out of it. And what it means for us and our clients is those cases are getting approved sometimes in 24 hours.
Yep, we've seen it.
So, you know, we're big fans of AI if it can get cases approved faster. So that's awesome. And then LIMRA, the insurance organization or insurance industry organization, came out with first quarter numbers for Canada. And this is, again, great news for our industry. Whole life premiums surged 15% in the first quarter versus a year ago. And that's 2 quarters in a row where we've seen double-digit growth in whole life premium. So why is that happening? Well, more and more people are realizing what an incredible place it is to park a portion of your money. So, you know, Canadians across the country are catching on that this stuff's good. So premiums are really going up. So whole life represents now 68% of all the premium in Canada. Okay. Whole life and UL represent 80% of the market, but whole life is 68% of the premium. So, you know, for those people that said, why haven't I heard about that before? Well, lots of people have, and there's billions of dollars going into it a year, and there's hundreds of billions of dollars sitting in it a year. So thought that was kind of great news for whole life. People are catching on. People are realizing what a great product it is. And then CNC news. Another exciting month at CNC, Control and Compound.
Yeah. So this month, like I mentioned, we were down in Nashville. Well, we were just outside of Nashville in Franklin, Tennessee for the And Asset Conference. And that was really cool. So Darren and myself and Jake went down there, and we were there with some names that you've heard us talk about before. Garrett Gunderson, the writer of the What Would the Rockefellers Do book. We've got that whole series that we've been putting out on the Rockefellers. We've teamed up with him to be able to launch it over here in Canada. So we were hanging out with Garrett. Caleb Williams, who puts on the entire event, was there. He wrote the book, The And Asset. It's nice to have a group of like-minded individuals sit down and really share what they're doing in the markets. And I know they're in the US, and we talk about this, you know, we hear a lot of content come out of the US versus Canada. And this really does show that in both countries, the strategy is the same, right? Like we're using the strategy in the same way. It's just a little bit of a difference in the product. And I'll tell you, I don't even know if we talked about product at a 2-day full steam. Like this was rapid fire, different advisors going up there and specialists in this going up there and talking to us. Product wasn't even talked about. We were talking about the different ways that people are using high cash value life insurance for strategies. Like there's a guy up there talking about foundations and charitable giving. They talked about funding children's education using these instead of the traditional. They've got things like RESPs over there, but using these instead. So the strategies still line up over here, which we love, chatting with people, learning what they're doing so we can bring it back over here to Canada and we can share it with our listeners and our clients and get them set up on it as well. So that was pretty neat.
Yeah, I love going to those events because, you know, we tell people every day your most valuable asset is you. You should be investing in yourself. And that's what we're trying to do consistently every month is we keep learning new strategies, new ways, and we share those with our clients because this is what we specialize in. And then from a podcast standpoint, we had a really cool a lineup of podcasts last month. We had Joe DePenta. So Joe, if you haven't listened to this one, Joe's podcast, Joe's a Stanley Cup champion. So we talk about that a little bit. And Joe is also a good friend of Control and Compounds and our EOS implementer. So he is the guy that helps us with EOS every quarter. And we meet with Joe a full day every quarter and we talk about EOS. So if you've been listening to our EOS journey or you're a Stanley Cup or a hockey fan, you should check that one out. We had a great podcast on 8 things you should have in your policy. These were kind of non-negotiables. Like if you have a policy, you've got to have this, 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 and this. So that was by audience request that we did that one. We talked about how many policies you should have in a podcast. And then we had the Rockefeller series part 3. And again, this Rockefeller book, for those that are looking to pass down wealth and pass down their heritage and their values, check out all the Rockefeller series. Get the book. Very, very exciting concept that we launched earlier this year.
Absolutely. And going into next month, we will have Rockefeller Part 4. So that will be coming out. We also have guest Gary Hibbert. So you sat down with him and you guys were talking about mini retirements, which I'm excited to hear this one myself.
I don't want you to listen to that
one. Mini retirements. So you're going to want to listen to that one. We also had tax implications of life insurance, which we get a lot of questions around tax implications on life insurance. We've got that one. And where does the money go in your policy? So when you make those deposits, where is the money going? Which really breaks down where are the participating funds investing those funds. We break it down, especially this time of the year when we're hearing about dividends. You're saying, okay, well, how are they able to pay these same dividends every single year and they're holding steady? We don't have that volatility. Well, we dig into that in this episode, so you're not going to want to miss that one.
All right. Well, listen, enjoy your July. We'll see you for the August update. Thanks for watching. Thanks for listening. Have a great day.
And happy Canada Day.
Happy Canada Day. Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.